Good morning, and welcome to your weekly market and value aligned portfolio review. Over the next few minutes, I'm going to walk you through exactly what moved this week, why it moved, and what it means for the businesses you own. This was a holiday shortened week. Stocks closed Thursday ahead of the Juneteenth break, and the story is simple to state and hard to overstate. A peace deal in the Persian Gulf pushed oil sharply lower. A brand new Fed chair pushed back hard on the idea of rate cuts, and money rotated straight into semiconductors and out of anything tied to crude. If you find this review useful, take a second and tap the like button. It helps more investors find this work. Start with the single force that set everything else in motion. Over the prior weekend and into Monday, the United States and Iran reached an interim peace deal, a memorandum of understanding that lifted the U.S. blockade of Iranian ports and reopened the Strait of Hormuz to commercial shipping. Picture these tankers actually moving again. The moment traders believed Iranian barrels were coming back, oil fell, and that one move rippled through every sector for the rest of the week. Dr. Ed Yardeni calls the deal shaky, and that caveat matters. The physical movement of tankers is still being worked out, even as the headline reopening was announced. Hold that image, because almost everything that follows traces back to it. Here's the path for today. First, the U.S. stock market recap, the indexes, the sectors, and the biggest movers. Second, the economic and policy update, where a new Fed chair just changed the tone. Third, the geopolitical picture is driving it all. And fourth, the part you're really here for, how the value aligned portfolio actually behaved, holding by holding. Four parts, one through line: oil down, ships up, services under pressure. Let's start with the tape. Look at the headline numbers, and they all finished higher. Look closer, and you see where the leadership really sat. The NASDAQ 100, tracked by QQQ, rose 2.67% for the week. But the equal weight S&P 500, every member counted the same, tracked by RSP, actually fell 0.80%. That gap tells you everything. This was a narrow, top-heavy week in which a handful of large semiconductor and AI names did almost all the lifting, while the average stock leaked lower. The S&P 500 itself reclaimed 7,500 and closed up about 2/3%. Small caps quietly pushed to a new high as falling oil pulled money into cyclicals. Quick favor: if a clear read on the market is worth your time, drop a comment with the one holding you most want me to cover, and tap subscribe so you don't miss next week. Now, break that same week into sectors, and the dispersion is extreme. 5 of the 11 sectors rose. Technology led, up 3.59%, because the semiconductor complex went vertical. Chips and chip equipment now make up more than 17% of the entire S&P 500. So when that group runs, the index runs. Industrials gained on the prospect of lower energy costs. And then look at the bottom of the chart. Energy fell 13.14% on the week as oil collapsed. Even the usual safe havens offered no shelter. Healthcare, staples, and real estate all dropped 5% to 7%. That's not fear. That's money leaving safety and chasing the AI trade. Zoom into the individual names, and the split gets even sharper. On the winner's side, Western Digital led the whole index, up nearly 33% on a wave of AI and cloud storage upgrades, with Micron riding the same memory supercycle. GE Vernova jumped 18% on a new outperform rating tied to AI power demand. But the number that matters most to this portfolio is on the right. Accenture fell almost 25%, the worst stock in the S&P 500 this week, and it dragged the entire IT services group down with it, sending Cognizant to a 52-week low on the read-through. Keep Accenture in the back of your mind. We're going to come back to it because it's the one event this week that genuinely tests a long-term thesis. Zoom into the individual names, and the split gets even sharper. On the winner's side, Western Digital led the whole index, up nearly 33% on a wave of AI and cloud storage upgrades, with Micron riding the same memory supercycle. GE Vernova jumped 18% on a new outperform rating tied to AI power demand. But the number that matters most to this portfolio is on the right. Accenture fell almost 25%, the worst stock in the S&P 500 this week, and it dragged the entire IT services group down with it, sending Cognizant to a 52-week low on the read-through. Keep Accenture in the back of your mind. We're going to come back to it because it's the one event this week that genuinely tests a long-term thesis. And here's that surprise. The Fed held the funds rate at 3.50 to 3.75% on a 12-0 vote, the fourth straight hold, and roughly 97% expected. Markets don't trade the decision, they trade the tone. In his first meeting as chair, Kevin Warsh dropped the easing bias, offered no forward guidance, and planted a flag on inflation. His words: persistently high prices are a burden for the American people. The recent past need not be prologue. The median dot for year end jumped to 3.8% from 3.4%, and 9 of 18 members now pencil in at least one hike. The 2 year Treasury yield spiked to its highest in over a year, settling near 4.19%, and stocks sold off that afternoon. So is Warsh right to worry? Yardeni's view and ours cuts the other way. His read is that the inflation we saw this spring was a one-time supply shock from oil, not a new trend. As that oil shock fades, the Fed most likely stays on hold rather than actually hiking. And the bond market quietly agreed with him. Even as the front end repriced for hikes, the 10-year yield fell from 4.67% in mid-May to 4.46% by Thursday. When long-term yields fall while short-term yields rise, the market is telling you it believes inflation will be contained over time. That's the signal under the noise. Let's put the geopolitics on the map because the details matter for what comes next. The US-Iran memorandum lifted the blockade and reopened the Strait of Hormuz, the choke point on the right of this map that a huge share of the world's oil flows through. That kicked off a 60-day window to negotiate a permanent agreement centered on Iran's nuclear program. The market took it at face value, where it counted. Brent crude collapsed, and pump prices in the US fell below $4 a gallon by Thursday. But notice Yardeni's warning at the bottom. The deal is shaky, and physical tanker traffic is still being sorted out. A clean handoff keeps oil low. A breakdown reverses these trades fast. Here's the whole week in one chain, left to right. The Iran peace deal leads to oil collapsing. Oil collapsing sends energy down 13%. That same drop in input costs lifts cyclicals and industrials up roughly 8%. And cheaper energy reignites the AI power trade, names like GE Vernova and the chips, because lower energy costs sustain the economics of the data center buildout. One geopolitical headline, and you can trace a straight line to nearly every sector move on the board. That's the map. Now let's bring it home to your portfolio. This is how the value-aligned portfolio's 5 best performers looked as of Thursday's close, and the pattern is almost too clean. AMD led, up 10% on the week, and now up roughly 151% year to date, as it keeps taking share in AI accelerators. Taiwan Semiconductor, the foundry that actually fabricates the leading-edge chips for everyone, rose nearly 10%. Broadcom added almost 7% on the same AI infrastructure demand. NXP rode the broad chip tide. The lone exception is Installed Building Products, an insulation installer with no AI story at all that was simply the lower rates, lower energy bounce. 4 semiconductors plus 1 cyclical, the chip rally in microcosm. Now flip it over. Here are the 5 worst performers, And the pattern is just as clean in reverse. Accenture is at the top, down almost 24% on the week. Salesforce and ServiceNow fell 8 to 9% on the same fear that AI agents could compress seat based software revenue. And then Merck and Eli Lilly, both down 5 to 6%, weren't company stories at all. They were defensives caught in the rotation out of safety. Three software and services names, two defensive. So the whole portfolio this week was one concentrated bet: own AI infrastructure, sell anything old economy or potentially disrupted. Before we study the one name that actually matters here, if you're getting value from this breakdown, the single best thing you can do is share it with one other investor who owns these kinds of businesses. That's how this work reaches more people. So let's give Accenture the attention it deserves, because it's the only drop in that group that reflects a real company specific event. Look at the left side. This was not a bad quarter on the numbers. Earnings beat at $3.80 against a $3.71 estimate. Revenue came in at $18.72 billion, up 5.6% year over year. The dividend was raised 10%. And 195 of the top 200 clients have stayed more than a decade. So why did the stock fall almost 24%? The right side. The Middle East conflict cost about $100 million in revenue and roughly $400 million in regional sales impact. Management widened the fourth quarter guidance range. A couple of large deals slipped into the next fiscal year. And underneath all of it sits the real fear that AI compresses legacy services revenue faster than new AI work replaces it. That's the question the whole market is now asking. For a long term owner, the honest answer is that a franchise this sticky, still beating and still raising its dividend, looks far more like a fear driven repricing than a broken business, while respecting that the AI services transition is genuinely real. Let's bring it together with three takeaways. One, this was a narrow week. The NASDAQ and cap weighted gains mask the flat to down average stock. Don't mistake the index for the market. Two, Accenture is the signal to study, not the chip melt up. A company that still beat earnings and raised its dividend while the market priced in serious doubt about the AI services transition. And three, the macro backdrop, resilient growth and a fading oil shock, supports staying invested rather than reacting to a single hawkish press conference. Own the businesses and let the rotation do what rotation does. If you want to go deeper on the one name that matters most here, watch my full breakdown of the Accenture quarter and the AI deflation debate next. I'll put it right here. And you can find this week's complete written review linked in the description and the pinned comment below.